There are 4 reasons separation between business and personal accounts is non-negotiable. And the most important thing I can tell you up front is that they are 4 independent reasons, not 4 ways of saying the same thing. Every coach I've talked to who skipped separation talked themselves out of it by collapsing the 4 into 1, usually whichever one felt least urgent at the moment, and then dismissing the whole stack. The way the rest of this module works only makes sense once each reason has its own line of protection in your head. 4 lines of protection, 4 different failure modes when they're absent. One protects you against losing your LLC's liability shield in court. One protects you when the IRS opens a Schedule C audit. One protects your books from becoming a manual reclassification job every month. And one protects your own ability to tell, in under a minute, whether the practice is paying you or not. They fail one at a time. Skipping separation doesn't fail you 4 times slowly. It fails you 4 times immediately, in 4 different ways. And the only thing protecting you is that you haven't been tested in all 4 yet. Take the LLC veil first. Forming the entity in your state costs maybe $500. Maintaining it costs $0 and 1 habit. Keep business money in business accounts. The doctrine the courts use to break through is called alter ego, and the test is exactly what you'd guess. Did the owner treat the business as a separate entity or as a personal wallet? Personal expenses paid from the business account and business income deposited to personal checking are the 2 facts the opposing attorney puts in front of the judge. $500 to form the LLC, and you give it away the first time you pay your home electric bill from the business card. Audit defense flips the burden in a way most people don't realize until they're in it. In a normal Schedule C audit, the auditor's starting point is your business account. They reconcile your reported income against the deposits there. They sample expenses and ask for receipts. With a separated structure, the personal account is irrelevant to the conversation. They don't ask about it. With a commingled account, you're the one rebuilding which transactions were business across every statement of every year being examined. The auditor doesn't have to prove anything was personal. You have to prove every claimed business expense actually was, with the personal noise as background. That's the burden reversal. The clean books argument is the one coaches dismiss as a luxury, and it's the one that wastes the most time per month for the longest. A separated business account produces a bank feed where almost every line is a business transaction. Your bookkeeping software categorizes most of it automatically, and you spend a few minutes per month on the exceptions. A commingled account produces a feed where every single line has to be touched by a human and classified business or personal before anything else can happen. The same monthly close that takes an hour in a separated structure takes 4 in a mixed one. 4 hours times 12 months times however many years you defer the fix. Sanity is the mental load argument, and I'd argue it's the one worth the most over a coaching career. With separated accounts, I can tell you in under 30 seconds what the business has: checking balance, tax reserve balance, card balance, done. 3 numbers, 1 minute, complete picture. With a commingled account, that question requires arithmetic in your head against transactions you have to remember the category of, and the answer is never quite right. You stop asking the question because the answer is too expensive to compute. The business goes opaque to you. The cost lands as a running a business problem, not as a bookkeeping problem. Let me put a real number on what skipping separation costs, using a composite I call Terrence. $60,000 of coaching revenue in his second year. All client payments going straight into personal checking. The IRS sends a CP2000 notice flagging a $5,000 gap between his Stripe 1099-K and his Schedule C. Bookkeeper quote to reconstruct the year is $400. He decides to engage a bookkeeper to catch up the full 24 months. That's a $1,200 engagement quote, plus higher monthly going forward because his books are messier. $1,600 minimum before any attorney exposure shows up. The cost of doing this correctly on day one was $0 and one afternoon at the bank. Open the separation self-audit before the next video. It's organized in 4 sections, one per reason. Mark the accounts you've already opened. Business checking, tax reserve savings, business credit card. Mark the mixing patterns you've already stopped. Client payments going to personal card paying business expenses, the reverse, transfers between accounts without bookkeeping entries. If you're starting clean from here, what you mark becomes your setup checklist for the rest of the module. If you've been mixing for a while, what you mark becomes your risk map and your input to Unit 8. Reasons clear, mechanics next. The order from here is checking account first, because every other piece of the structure plugs into it. Then the tax reserve savings, which is the account that actually saves the practice. Then the business credit card, which is a separation instrument first and a rewards instrument second. Then the documented flow that moves money from the business to you. And finally, the cleanup protocol for anyone who already has mixing to unwind. The 4 reasons we just walked are the why. The next 7 videos are the how.